We've made a strong start to 2017 against a challenging backdrop. Once again, we're reporting growth across each of our sector's key metrics. And this is largely a reflection of the strength and quality of our retail assets, superior management, and our continued focus on creating differentiated destinations in growing consumer catchments. Our strategic decision to build a diversified portfolio tilted towards growth markets is benefiting from exposure to Ireland and structural growth in the premium outlets market. We have a well-balanced portfolio with 57% based in the UK and 43% across the rest of Europe, giving us greater exposure to the best performing consumer markets. At the group level, net asset value increased 4.3%. Valuations were 10.5 billion and generated a capital return of 1.8% in the first half of the year, with a significant contribution from premium outlets. Importantly, 83% of the portfolio growth was due to income generation. Earnings grew by a healthy 6%, particularly boosted by like-for-like net rental income, which increased 3.4%, reflecting a strong contribution from our higher growth markets of Ireland, up 12%, and premium outlets up 11.7%. Underlying our confidence in the outlook, I'm delighted to report that the board has recommended an interim dividend of 10.7 pence per share, up 5.9% year on year. The trading environment for retailers in the first half of this year has undoubtedly been more challenging, with increased costs on the one hand and political uncertainty feeding into weaker consumer sentiment on the other. However, against this backdrop, I'm pleased to report record-beating leasing activity in the period, with volumes up 44% to £18.1 million. Now, whilst deals are taking time to complete, it's encouraging to note that we have seen no major changes in incentive packages. This reflects retailer priorities to focus on prime retail space as part of an increasingly sophisticated multi-channel strategy. During the period, we introduced a number of firsts across our portfolio, including Smiggle's most successful global launch ever in Ireland at Dundrum and Coach's first standalone store in Birmingham at Bullring. We're also seeing a continuing trend for major international brands to upsize into flagship space, including Zara and JD Sport at Brent Cross and H&M at O'Parinor in France. We continue to benefit from the repositioning of our portfolio into best-in-class European retail destinations in growing consumer catchments. And our diversification strategy is further bolstered by our exposure to the exceptional growth of our Ireland and premium outlet divisions. In the first half of the year, premium outlets delivered sales growth of 11%. With our partners in VIA, we continue to work to reconfigure and enhance the portfolio of outlets, with the recent opening of a 5,500 square metre extension at Bataviastad in Amsterdam, welcoming 45 new retail brands and increasing footfall by 13%. I'm also delighted to announce the acquisition of a further outlet as part of the VIA portfolio, taking the gross asset value of the fund to £1.1 billion. Oslo Fashion Park in Norway is a 16,000 square metre scheme. We've already identified a number of exciting opportunities to lift the quality and performance of the outlet through re-merchandising and asset management initiatives. And in Ireland, we continue to see exceptional tenant demand for the very best space. Like-for-like ERV increased 2.5% in the first half of the year, principally driven by the strong performance at Dundrum. The economic and consumer backdrop remains favourable, with GDP growth in Ireland forecast to outstrip the rest of Europe. Together with our asset management plans, this underpins our future growth expectations for the portfolio. In developments, we are making great progress with our on-site retail park schemes in Rugby, Didcot and Park Towie. Our Kirkcuddy redevelopment completed during the period, with the final units successfully let to Oak Furniture Land in June. In Rugby, Phase 2 of Elliott's Field is nearly 80% pre-let to major homewares brands, including Oak Furniture Land and Sofology, and we remain on track to open before the end of this year. In line with our new net positive targets, which we launched in March this year, I'm delighted that Elliottsfield Phase 2 has been recognised as the world's first carbon neutral retail park and the first to gain an outstanding BREEAM rating. Turning to our major London schemes, we continue to make good progress at Brent Cross and Croydon. Detailed planning applications have been submitted for both schemes and we anticipate decisions in the coming months. At Brent Cross, we also expect a decision on the CPO in the autumn, which will allow us to move forward with land assembly and work towards a start on site in 2018. In France, plans to extend Cergy are moving ahead. We have selected a contractor and we anticipate a start on site in early 2018. Having realised close to £100 million of disposals, including the sale of Thanet Retail Park, we remain confident that we will meet our full-year target to recycle £400 million worth of capital from the portfolio to fund our exciting development pipeline. Looking ahead to the second half of the year, I'm confident that the high-quality European retail platform we have created is well positioned to withstand any further external headwinds and to continue delivering for our shareholders, our retailers and our customers.